Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, September 9th, 2022. Hope you're all having a great week. It's a beautiful day outside. Hopefully you'll get to enjoy it at some point this weekend. We're back to update you on all things markets and economies after a week off. There was no shortage of news, so we want to bring you up to speed, talk to you about what has transpired since the last time we got together and spoke over video, and what we expect to happen as we move forward. So just taking a step back, looking at the macroeconomic overview, right? We had a nice rally going through the month of July into the middle of August. And then we had that annual Jackson Hole Symposium where the Federal Reserve gets together in Wyoming. They discuss monetary policy. And Jay Powell gave this speech that really echoed around the financial community, where he said, essentially, we will do whatever it takes to bring down inflation, even if it means inflicting pain on U.S. businesses and individuals, as if they haven't inflicted a lot of pain already, right? Now, obviously that message was received by the market. We saw a big sell-off that was on Friday about 2 weeks ago, okay? And since then, the market has tried to retrace some of that decline. Now, the problem that this Fed has is they have a credibility problem, and that is really what they're pushing back against and trying to restore some faith that the market actually believes what they say. Now, why does this Fed have a credibility problem? Well, that is because under the leadership of Jay Powell, over the last 6 years, this Fed has made 3 large catastrophic policy errors, and they are, in our opinion, on their way to making a 4th. Now, why does this group of central bankers, who are clearly very smart and understand finance and economics very well, why do they keep making major policy errors and have to do total about faces when they realize those errors? And that is because the Fed, for decades, has used lagging economic data to make decisions in the real time about interest rates, right? This is why they kept rates too low for too long, which caused some asset bubbles in certain areas of the economy. And this is why, inevitably, when they raise rates like they are now, they will raise them too far and too fast before they inevitably break something, right? And we've seen this cycle before, most recently in 2018, where the Fed was hiking rates. The market, the bond market, treasury market was screaming out that they had done enough. The Fed didn't listen because they were using lagging economic data. And again, they went too far and had to reverse course. So we see this playing out as similar, right? We think the Fed will continue to push forward with interest rate hikes, probably 1 or 2 more, right? We know September's coming. There's going to be a rate hike this month, and you're probably going to see another one next month. After that, they'll have to reevaluate. But the evidence that we see, looking down supply chains, looking behind the scenes at the global economy, is that inflation, particularly in certain very sensitive areas like used autos, auto parts, etc., is about to fall off a cliff. Okay, the Manheim Used Auto Index, which we have cited in many previous videos as inflation was moving up, has started to drop in a very big way month over month, right? And that trend has been in place for 3 months now. So we think inflation is starting to roll over and turn to deflation, but we think the Fed is going to continue to press onward. And that is why, folks, people have a crisis of confidence in these markets right now, because they see a Fed that they don't think they can trust. And the reason they don't think they can trust them is just, and not to go over the whole timeline of the Fed, but just go back 1 year to the Jackson Hole Symposium, where the same Jerome Powell gave a speech and said, inflation is transitory, not something we're worried about. We're not even thinking about raising interest rates, and we think the U.S. economy will adjust just fine when we do. Well, a year later, right, inflation's a big problem, was anything but transitory. Not only have they thought about raising rates, they've done so many times. So again, the market hears what Powell's saying, and we think this is his effort to try to convince the market that he's serious. But what he says and what he does may turn out to be 2 different things. So that's what's hanging over the market, right? That's the cloud right now, the monetary policy cloud hanging over the market. So let's take a look at the market itself. Here's the S&P 500 this year, going back over the last 9 months. Now, we've seen markets clearly in a downtrend, right? And we've seen several bounce attempts here that have failed. So from a macroeconomic standpoint, we just discussed that, where the economy is, where the Fed is. Now, let me talk to you with my technician hat on, right? This is what market technicians are seeing. Market technicians are seeing a market with a very clear downtrend, right? Acting as overhead resistance. Every time the market pulls into this very sensitive area, as represented by this downward trend channel, the market seems to roll over. Now, previously, right, this is where we topped in January. We made a nice rally into this in early April and failed and went on to make new significant lows. So same type of action here. Now, we had a nice rally going from the end of June through, let's call it early to mid-August, and then the market started to get weak at that very spot. Now, we think this part of this is the psychology of a downward trend channel, right, which investors are watching very closely, really more on the trading side, but also very weak volumes in mid-August as we're in the dog days of summer, and we just didn't have that oomph to push ourselves over the top. Now, so far, the market, after selling off a little bit, has responded well. If the market can hold in this area here and continue to move higher, we would have successfully created a higher low, right? Where basically, markets created the regional low and have made several pullbacks along the way, but have never breached this low, right? So, this is essentially as unless or until we break through this, right? The market made its low in June. Now, a lot of technicians believe, based on Fed policy and a potential Fed policy error, that this is a given. We don't think it's that crystal clear, but let's just take a look at the charts. Now, so this is over the 9 months, right? Now, over the last 3 months, we've seen nice moves in the markets, a little relief for investors. And again, this is just a zoomed in view of what we just discussed. Markets hit some overhead resistance. We see some natural selling. Now buyers are stepping back in. All eyes are going to be on next week's Consumer Price Index report, right? The CPI, it's coming out midweek next week. We saw some slight positive signs in last month's report. We need to build on that this month, right? We cannot see inflation just zoom higher again, because that would mean any progress we made on inflation, CPI last month, is in the rearview mirror and inflation's continuing. So markets are really just going to be uneasy until we get that report. Let's take a look at a couple other things we think are relevant. So this is the McClellan oscillator. I'm not going to bore you to tears about what it is, but basically what this tells us is where the market is in terms of being oversold or overbought or in neutral territory. So anytime we see this internal indicator come down to the bottom area of this chart, we're in oversold territory. Markets are likely due for a bounce. So we came into oversold territory a couple days ago, and here we are getting a bounce in markets. And anytime we move up into the upward trend, or the upward line on this chart represents overbought territory, meaning stocks have probably moved too far too fast and are due for a little bit of a pullback. So it's natural we're getting a bounce out of oversold territory. Whether or not it sticks is the key. Now, this is something we want to point out because, every once in a while in our business, you see a chart that really just blows your hair back. Now, what you're looking at here is the amount of what we would call speculative hedges bought by institutions, right? So these would be, without getting into the weeds, these would be in the options market. People are buying put options, basically betting on the market to fall. Now, whether they believe the market is going to fall, or they have a ton of stock that they own and they're just using this as a hedge, we cannot tell by looking at this data. But what we have seen as panic has set in that the Fed is going to make a mistake is we have seen speculative traders take on negative bets on the market to a magnitude that we have never seen, folks. Traders put on more than $8 billion of speculative negative hedges last week. And just to give you a frame of reference, here's the 2008 crisis. Okay, it was about $2 billion. So we've gone 4 times more than that. Now, again, you might look at this and say, well, it's obvious the market's going to go lower, right, if all these people are betting on it. The stock market is the one place that does not reward the herd mentality. Never really has. We don't think it ever will. So the fact that the trade has gotten so crowded now, where everybody expects a crash, actually makes that scenario less likely. We're not saying it's not going to happen, but we think that this is something that gives us pause, that the market may try to go the other way here, because you have a lot of people who are, quote, short this market, right? They're betting on it to fall. And if that doesn't happen, this could create a frenzy of short covering, which short covering equals buying, right? And if we have this many people short the market and they need to cover because the market does not do what they expect, it could cause a very sharp move in markets higher. So again, just something to keep in the back of your mind. Yes, people are positioning for a crash, but the market hardly ever, if never, rewards everybody being on one side or one corner of the market. So that's something we have to see how that plays out. And also, we have patterns, seasonality patterns playing out in the market. So what you're looking at here is the S&P 500 midterm election year seasonal pattern. So what we're looking at, there's multiple lines obviously on this chart. We're looking at the red line. You have the second year of a new Democratic president. And it's actually very interesting how accurate this has been so far this year. When we look at this red line, right, basically markets selling off until late June, right, pretty accurate, getting a nice rally through July and into mid-August, some more weakness coming through. Now again, folks, this is seasonality patterns. So, you might look at this and say, well, this suggests we're going lower into November, sell it all. It's not a guarantee. It's just something we look at as a frame of reference point. But however, there is some positivity to take from this as well, right? This seasonality pattern would suggest that we are pretty close to the lows of the year for the market. If they weren't in June, maybe sometime in November, right? If seasonality was the only thing guiding us. So again, we look at this, we compare it to the other internal indicators and sentiment and all that stuff that we have to use to make a technical assessment. And of course, the fear and greed index is basically neutral right now, right? We had ticked up into the greed category about 2 weeks ago. Market sells off. Naturally, we see some of the oscillators pull back. So investors are right where you would expect them to be coming into a pivotal consumer price index report next week. So all in all, when we look at the market, we've got a lot of volatility. We're still got a lot of work to do to regain this positive trend line here, and of course to get back to all-time highs. And I think that these are the signs that we want to see in the market, where the market is able to move up with some strength and hopefully create a higher low and continue to move higher. What would be a good thing would be to see the market continue higher, break this trend line, and make a new high in the local level, meaning over the last couple of months, above this point here. If the market comes into this trend line again and we see more weakness and it rolls over, then the likely path for stocks, or I should say the path of least resistance, at least in the near term, will be lower. We still believe that many individual growth stocks, excuse me, someone's trying to call me. We still believe that many of the individual growth software and tech stocks made their lows in May and will not revisit those lows. But again, the market as a whole, a broad market, is affected by many stocks that we don't own. So we have to keep an eye on all of them to make sure we give our investors the best chance for success moving forward. So again, it's been a tough road. We understand that. Volatility really wears on investors. It can make you stir crazy at times. Like, we just have to do something. But folks, markets go through cycles. We will see expansionary cycles again. We got to get through this bear market. We got to get through this contraction. We will do so. And that's another point I wanted to make, right? We expect from time to time bear markets will happen, and we expect to see declining values in those bear markets, right, folks? There's no two ways about it. We know that to be able to reap the rewards of financial markets in bull markets, we have to go through those bear markets. We know losses will happen, but the losses won't be permanent, and they certainly won't be everlasting, and we will live to see good stock market times yet again. So if you have any questions, reach out to us. Always here to talk to you about the things that matter with your money. Again, we had a lot to fit in today after a week off, so we wanted to bring you up to speed. But we'll see you back next week for our Heritage Market Update. Have a great weekend.